Hello everyone, welcome to another episode of In Conversation by Advisor Coach. Today in conversation, our guest is Mr. Aniruddha Naha, Chief Investment Officer, alternates with PGIM India Asset Management. Aniruddha Naha has over 22 years of industry experience in equity and debt markets. Until March of 2023, Aniruddha was also the head of equities with PGIM India Asset Management. Welcome Aniruddha to In Conversation by Advisor Coach today.
Thank you very much. Thank you for having me.
Thank you very much for joining in. So let's jump straight into the markets. So what are your views of the markets in the near term? And the extension of the question is also, what do you believe of the equity markets in the next 5 years to 10 years to come, Aniruddha?
Sure. I think this is a question, I guess, it's at the back of the mind of everyone. See, India has seen a phenomenal equity return, generation over the last 3 to 4 years since COVID, and backed very much by earnings to that extent. What we foresee probably into the next 2 quarters, globally there are certain challenges, and India probably will also have to face it to that extent. Inflation is pretty real, and we saw the numbers come out for the US yesterday, and reflected in how the yields have moved. If inflation continues to remain sticky, which happens to be the case, and if you look at it, how crude has moved from say $70 to about $90 today, and with the geopolitical risks that one foresees, it is very unlikely that we will see inflation come off in a hurry in probably the next 2 quarters.
Sure.
The second thing that we look at is earnings from a company's perspective also is going to be a little subdued going ahead for the next 2 quarters. So the next 2 quarters, we believe, will be a time where the markets could consolidate, could see some amount of correction. But mind you, or to answer your second part of the question, how does one look at the markets over the next 3, 5, 10 years? I think these markets will belong to India to that extent in terms of equity returns. The next 6, 9 months, if the markets go through some amount of time consolidation or price consolidation, it will be a good time to build the future portfolios. So we are excited. We are a little cautious given where the market macros are, given where the valuations are. But every correction would be a great time to go ahead and build portfolios according to us.
Sure. So could you also highlight some of the strategies in your alternative space?
Sure. See, the alternate space, I took it over a year back. And since then, we have been coming out with different strategies. On the PMS side, we've been running and very ably managed by our Chief Principal Officer, Surjit, who's been there with us for the last 3 years. So we have a flexi-cap kind of a strategy, which is the core strategy. We have a mid and small cap strategy running out there, which is known as Phoenix. And then there is an India equity portfolio, which is an all-cap strategy with about 20-25 of the best ideas.
Sure.
So these are 3 strategies which are run on the PMS side. On the alternates, we've just launched one product as of now. It's a flexi-cap kind of a product. And we are looking to launch probably a mid and small cap at some point and a long short at some point of time.
Sure.
The idea is not to launch too many products, but try and offer relevant solutions to our clients, which will probably be a satellite strategy or a completion strategy to our mutual fund side.
No, that certainly makes sense to grow the current products which you have already available, and of course grow them in size from there. So the favorite question today, what do you believe about the mid cap as well as the small cap segment? Are they overvalued? What would you advise? What would you suggest at this point of time?
Sure. See, I think the returns which have come through in the Indian markets over the last 3-4 years have definitely been backed by earnings. But I think what has also happened is return is a combination of earnings coming through and PE expansions which follow through. I think the PE expansion in many of the pockets, especially in the mid and small cap segment, have got a little stretched. And I don't mean the overall mid and small cap part of it, of the market, but certain parts, some pockets have definitely got stretched. One needs to be a little careful given the fact that the next 2 to 3 quarters, the earnings might not play out the way it has historically played out to that extent. Our sense, again, in the mid and small cap segment, if you take a 3-5 year view, there are very, very exciting companies sitting out there. You know, the large cap companies today have actually come through that journey of being a mid or a small cap at some point of time. And large part of wealth creation happens when you ride this journey from probably a small cap to a mid cap or a mid cap to a large cap.
Right.
So we remain extremely positive there over a longer term. And by longer term, we mean 2 years, 3 years, even a 5-10 year perspective. I think given the macro challenges globally, one needs to be a little cautious, especially where valuations are a little stretched and earnings seem to be a little subdued to that extent. The next 3 to 6 months will again give you an opportunity at some point, if you get these stocks probably 10-15% lower, to go ahead and build a good portfolio around this segment of the market.
Sure. So any investor at this point of time would like to invest into the mid and small cap. Of course, this is for the longer term period. Would you suggest doing that?
Oh, yes, absolutely. Now, see, I think so. There is absolutely no correct time to get in the markets.
Right.
As long as, as long as the next 3, 5, 10 years look good,
right,
and you're going to get inflation beating returns, there is absolutely no doubt one should look to invest in it. Now, it's a matter of the investor's risk appetite and how he manages, let's say, drawdowns.
True.
If the investor is ready with a 10-15, with a mindset, with a mindset to take 10-15% kind of a drawdown, he should go ahead and invest. There is absolutely no doubt on that. In case he wants to time it, which is frankly speaking reasonably difficult according to me, the next 3 to 6 months probably is a good time to go ahead and spread out. There is no question one needs to be invested. It's only a matter of how do you go ahead and invest, whether it's a lump sum or you spread it out over the next 6-7 months.
Absolutely. I totally agree. If any investor is coming for the long term, then I think any time is a good time for him to, or him or her to start investing. Absolutely.
Absolutely.
So what is your investment philosophy and how have you been different? If you could just provide some details on that as well.
Sure. So it is not that we've been very different. I think so for us, a few tenets of our philosophy have helped us eliminate or reduce mistakes to a large extent. So our philosophy starts with the fact that capital protection is very important. Return of capital is more important than return on capital. Now the question is, how do you protect the downside? Okay, the first thing we do is, as a team, we are very sure of what we will not do. And once that is decided, it helps us, focus on what the smaller portion of what we will do.
I think extremely important statement you made there, what you're not supposed to do.
Yes. I think so that is where we started off. It helps us in a long way, So you throw across a company to us, we at the start, depending on the parameters that we look at, could very objectively say in the next 5 minutes whether we want to work on this company or not. And that is very important. It helps us focus on the companies where we want to actually start working to that extent. We generally have avoided IPOs. That is something that we've avoided. Our sense is, from a safety perspective, we look at historical operating cash flows. We look at the cleanliness of a balance sheet. And we look at the promoter's intent and how it is aligned towards the minority shareholders. Okay. Now our team has an average experience of almost 15 years plus. Me being there in the markets for 22 years, we generally throw across a name we are reasonably sure whether we want to invest into that. So our checks and balances are there, and we do a lot of third-party checks and balances before going ahead and investing. And that is that safety net part of it. We spend a lot of time on the safety part of it. Once that is done, I think so the philosophy then shifts towards what is the kind of growth. And the third leg of it, which is equally important, is what are the valuations. Okay, I think valuations are very, very important in investing. You need to buy a good business at a right price or a reasonably right price to make money over a period of time. And that is something, as a framework, it is safety, then followed by growth, and then followed by valuations. But that is what we stick to.
Sure. And is it well integrated with your global investment philosophy as well?
PGIM globally, they have run pretty independent teams. And by independent, we mean that the local team has the full independence in deciding what is the framework going to be.
Sure.
Okay, of investing. The only commonality across all teams is what is the kind of risk management we do and what are the kind of compliance that we go ahead and follow. Other than that, we've got complete freedom to set up our own philosophies. The only thing we need to do is to follow those philosophies in a very disciplined manner.
Sure.
And that's what we've been doing.
Sure. So pretty much global to local.
Yes, absolutely.
Wonderful. Wonderful. So why do you believe alternative products should be in a client's portfolio when the mutual funds are giving enough exposure to the client in the equity as well?
I think that's a very relevant question. The first thing is, I don't think alternates need to get into everyone's portfolio, one and everyone. Alternates is a very specific part of the market. The few things which highlight what alternates are is probably the concentration of portfolios, the thematic variations that can be brought about in terms of how the portfolios are run. There could be very specific theme portfolios that could be run. It could be customized, and these are usually high ticket items. Okay, the regulator mandates that it starts at 50 lakhs.
Of course.
The PMS.
Yeah.
Now, what happens is these products come with their own risks. So one needs to be very aware of it. Because it's a reasonably higher concentrated portfolio, etc., you would see reasonable amount of drawdowns and upsides whenever it happens. So the investor needs to think, the advisor needs to think that in the overall basket of theme, for an investor, does it make sense to go ahead and, push a PMS or an alternate, frankly speaking? Our sense is anyone with a net worth of less than 5 crores investable surplus, I think he could very well stay with the mutual fund industry, and the mutual fund industry is doing a reasonably good job sitting out there, giving you different sectoral and diversified portfolios. I think beyond that is where people who would want to see a differentiated, a little high risk appetite coming through just because of the comfort of the net worth that they have, that is where probably alternates will go and fit in. Yes, what alternates can probably provide you is, it can go ahead and provide you a very thematic product, which probably will expire in 3 years' time, but it's a fantastic time to go ahead and invest now with a 3 years perspective. Those are things which probably mutual fund, in its earlier avatar, probably a closed-ended fund would have been able to offer. But those are things probably which a mutual fund might not be interested in offering given the longevity of a theme. Right. And hence that is where probably alternates would step in. Of course, on the alternate side, you have the Cat 2, Cat 1 categories also, and they are far more evolved in that sense. Unlisted equities, private credit, etc. These are segments which the mutual fund don't understand, or are not able to participate in, and a common investor who is investing into a mutual fund could probably stay invested into the Indian markets without even participating into some of these themes.
Sure. So it's a good amount of participation happening in more concentrated portfolio in things, securities which mutual funds are not allowed to invest into. So obviously an alternative products is a good alternate for an investor with a certain net worth and above to start looking at investing in these products.
Absolutely. Absolutely.
Wonderful. So through this in conversation today, what message would you like to give to investors in the current market situations, and also to the advisors and mutual fund distributors for the asset allocation process, looking at the markets where we are today?
Sure. So I think to the investors, India happens to be probably be the country to look at over a 3, 5, 10-year periods.
Yeah.
But please understand, equity markets are not linear in terms of how they generate returns. They will also go through their time corrections. There are macro challenges which one needs to be aware of. But use the opportunities or use the gunpowder that you have for investing into equities into every fall. I think the next 6-9 months would be a great time to build portfolios and then hold it over the next 3-5 years or probably even a decade. And I think Indian equities will reward these investors very well. From an advisor's perspective, I think AIFs, PMSs might not be a product which can be pushed to every investor, but given the return expectations and the risk appetite for an investor, which an advisor is the best, he is the best enabled to assess that.
Right.
wherever it fits in, it starts making sense because these portfolios will probably be differentiated vis-a-vis the existing mutual fund portfolios. The overlaps would be less. There would be some amount of concentration, and concentration, along with the fact that it brings some amount of risks, also brings in enhanced returns. So from that perspective, these have to be dished out to people who really have the appetite to take it. But from overall asset allocation perspective, I think today equities from a longer term perspective probably would be the asset class that I would bet on over the next 3, 5, 10 years. So that is something that one needs to focus on, depending on one's age, risk appetite, and return expectations. I think whether it's a mutual fund equity or through an AIF or a PMS, that is the advisor is best placed to do that.
Absolutely. And equity markets are no one's slave, as we always say. And long-term investing is the only solution.
Absolutely.
And choosing the right investment management company and leaving the money on a passive manner for a few years is the best way, I do believe, that to invest in the equity for the long term, for the wealth creation process. Great, Aniruddha. Wonderful insights through you today about your philosophy, about the overall markets from the near term and the long term perspective as well. So thank you very, very much for joining in today in Conversation by Advisor Coach. I wish you the very best, and thank you once again for taking your time.
Thank you. Thank you for having me here. It was a pleasure speaking.
My pleasure as well. Thank you very much. Bye-bye.